Hi, I'm Matt Collins. I'd like to welcome you to Bob Weber Auto Mart on Douglas Avenue here in Racine, across from Douglas Park. We specialize in 1-year-old, low mileage, almost new cars. And if you'd like to stop by and see them, or see them on our website, bobweberautomart.com, we could save you between $5,000 and $10,000 on your next almost new car purchase.
I'm Michael Burke, and this is Money Talks. We're going to start part 2 with Justus Morgan at Financial Service Group. Part 2, that is, of talking about when it makes sense, the most sense to collect Social Security benefits. A topic that applies, I think, to a lot of people in this country right now. Justus, we left off, we had just started to talk about work as a decision-making component of Social Security. So you want to explain that again? How does your future work plans, once you're hitting about full retirement age, how work plans come into the equation?
Yeah, so it's actually for folks that start collecting at 62 prior to their full retirement age, where if they keep working at some level, there can be an impact on the amount of their Social Security benefits that they collect. In particular, and this is often a misconception, when you hear people say, well, if I earn above a certain amount, I start to lose my benefits. To a certain extent, that is true, because if you earn above, and next year the number is about 15,000, if you earn more than that, Social Security will start to withhold your benefits. Mm-hmm. For every $2 that you earn, they withhold $1 of benefits. Okay. So, as an example, if you earn $20,000, that's $5,000 or so over the limit, they'll withhold $2,500 of benefits. Mm-hmm. And they figure out how many months...
Which sort of effectively cuts any earnings above that threshold in half. So.
It does. So, and that's why most people don't like that rule, because they end up missing a month or a couple of months worth of Social Security payments. But what ends up happening is once you do reach your full retirement age, Social Security recalculates your monthly benefit, and they'll actually increase that benefit based on the number of months that had been withheld. So you end up, assuming you live long enough, you end up making that money back that had been withheld. But in the short term, you end up foregoing a few months at least worth of payments. And if you earn too much, perhaps all of the benefits.
And this all applies before your full retirement age, again, between 62 and your full retirement age. So something to keep in mind, it makes some sense to work if you're going to live long enough, but in the short term, it's going to feel like you're not making very much money at this job.
It will, but recognize they're not withholding, dollar for dollar based on the benefits. So you are still money ahead by continuing to work, and plus when the benefits recalculated, you will make more. And there's also a couple of special rules when it comes to working. As we talked about in the last segment, pretty much everything that deals with Social Security is somewhat complicated. So in the first year of retirement, it doesn't matter how much you earned before you started collecting, so that $15,000 figure is not relevant in the year you start collecting. It's a little bit different calculation.
Oh, really? Oh.
And then also at the back end, when you reach your full retirement age, there's some special rules for that year. And then after you reach that full retirement age, you can earn as much as you want. There is no limitation on work earnings in your benefit.
And if a client's talking to you and says, I want to, I know I want to keep working till 70, maybe 72, I'm healthy and I like my job and things like that, how does that play into does there come a point where working is irrelevant to the amount of Social Security you collect? Because before your full retirement age, it's relevant.
Absolutely. So for a lot of folks that we talk to, if they're planning to continue working, most of the time they're not going to start collecting Social Security, just as kind of rough rule of thumb. Once they reach that full retirement age, which is about 66 for most people today, they can certainly start collecting, but they'll miss out on those delayed retirement credits we talked about last time. But once you reach 70, those delayed retirement credits stop. So there really is no reason not to start collecting Social Security, even if you are still working. So,
I don't know, we didn't exactly dwell on this, but that 8%, just to come back to that again, and we're talking about now for every year after full retirement age that you delay collecting, it's an 8%. You look at that as an investment, right?
We do. So for a lot of folks, we'll compare what the rate of return is by waiting to collect Social Security versus the alternative would be possibly drawing from some of their other investment accounts. And when you look at it through the lens of an investment, it's very attractive because not only do you get that 8% a year benefit, you're also building or increasing the survivor benefit, which we haven't talked about yet.
Yeah, we'll get to in a minute.
Okay.
Yeah.
And so there's a number of ancillary benefits to waiting than just that 8% a year. And I think makes it even more attractive.
Yeah, and in today's world, 8% return on investment is fantastic and almost found nowhere else. So what's this survivor benefit you just mentioned?
Yeah, so for married couples, there's a couple of other Social Security benefits that they're eligible for. One is the survivor benefit, which means at the first spouse's death, if both of them were collecting, the survivor receives the greater of the two benefits.
Oh yeah, because the amounts could well be different.
Exactly. So in a lot of situations, you might have the person who had the higher income through all their working years might be collecting a $2,000 a month benefit, and their spouse might be only collecting $1,000. Well, at the first spouse's death, regardless of which one, the survivor gets that $2,000 higher benefit. And so that's kind of factored in as the survivor benefit.
And you had mentioned these various steps we've been talking about to increase your benefit is going to then help your spouse even after you're gone.
That's correct. So if that high earner spouse continues to wait, they accrue that 8% benefit. That survivor benefit also continues to get stepped up along the way.
You also mentioned earlier before the show something called a spousal benefit. What is that?
Yeah, so while both spouses are still living, the spouse of the worker is eligible for a spousal benefit that is typically 50% of the worker's benefit. And that's been a provision that's been around since the late 1930s. And back then you had a lot of single wage income households. And so the idea was to provide some type of benefit to that homemaker. And I guess instead of a 100% benefit, they decided with a 50% amount. And so that benefit is still present. And so a lot of the analysis that we do, especially when we've got couples where both of them worked, we look at, okay, what are some of those spousal benefits? Does it make sense for one person to collect that and defer collecting their own individual benefits? And that's where things start to get a little bit more complicated and interesting.
Yeah, interesting. Yeah, very interesting. You also mentioned to me something I thought was very interesting, which is the spousal benefit can even be paid to someone after a divorce.
That's right. Just because you're not currently married doesn't mean that ex-spouses are not eligible. So there's some special rules to be able to collect a spousal benefit and even a survivor benefit for that matter from an ex-spouse. You have to have been married for at least 10 years, been divorced for at least 2, and currently unmarried.
Okay.
So we do see situations.
Oh, so if after a divorce the spouse remarries, then that cancels that out.
That's correct. They would then be eligible for benefits through their new spouse.
Gotcha.
Versus their.
But if they're still single, still divorced, then they can draw off of.
Absolutely.
Yeah.
And we've had a number of situations where clients had no idea that that benefit was even available. And even though they've been divorced for years, they're able to collect a little bit of a benefit.
Does that affect the higher wage earners' Social Security collections? The fact that the divorced spouse is collecting from it?
Yeah, good question. It does not have any impact on the other person's benefits whatsoever.
Okay.
So
okay.
you can,
So even if you may not like it in concept, it's not going to affect your benefits.
Correct.
Let's get into the whole idea. Obviously, there have been countless discussions at the congressional level about the solvency, the future of this whole Social Security system, and that's sort of the foundation of this whole discussion. So, what's the degree of solvency of it? And do you ever hear people say, "Well, it's not going to last anyway," therefore they jump to a certain decision?
Sure, get it while you can, right?
Yeah.
And we are making some assumptions when we do any of this analysis and start to project out, 20, 30 years into the future. We're assuming that the program's still going to be around, right?
Who's we in that sentence?
When we're doing the analysis for our clients.
Okay.
And so collectively, it's a joint decision between us and the client of, is the program going to be around?
There are some federal projections right now. Do you know what those are?
There are. So we try to remove some of the emotions from the decisions that we make, and so look at some of the facts. And right now, the Social Security Administration is projecting that by 2033, the trust fund actually runs out of money.
Mm-hmm. By the way, that's 20 years out from when we're doing the show.
That's right, and that
that's
sounds
very
pretty
far.
scary.
Yeah.
It's really in terms of life expectancy, that's not that far out.
Right.
But when you start to drill into some of the details, what that means is that the trust fund is no longer has any money, but there's still revenue coming in the form of payroll taxes. Mm-hmm. And just from those payroll taxes, it's estimated that they'll be able to continue to pay 77% of the benefits mm-hmm. in 2033. So that's kind of the response to the kind of the knee-jerk reaction of, well, it's going to go bankrupt. Well, that's not entirely true, mm-hmm. right? There's still going to be enough money coming in to pay a certain amount of benefits. Granted, it's not 100%, and I certainly don't want to minimize the seriousness mm-hmm. of the issue, because it does need to be addressed.
Right.
But at the same time, I don't think it's catastrophic situation.
And it sounds like you also don't think it's a good way to decide when you're going to start collecting your benefits.
Absolutely, because I think looking at the research and also some of the potential solutions.
Let's talk about those.
Isn't going to result in the system disappearing. Remember, we talked about there's over 46 million people relying on this program right now. That's a lot of people that all of a sudden see their benefits disappear. Mm-hmm. I don't think that's probably going to happen. And so there are a number of proposals to fund the system, ranging from increasing the payroll tax, increasing the retirement age, changing how the benefits are calculated, changing the inflation adjustments. There's a whole variety of options.
And these things, of course, can all be done very incrementally, where they're semi-painless, but they make a difference, right?
That's correct.
Yeah. All we need is a Congress that will take action now.
Well, that's the key.
Simple,
right? So I think the solutions may be simple, but actually addressing them is anything but.
And as we wrap up, there's actually a website where people can go and take a look at some of the potential ways to massage it into better health.
That's right. There's a really helpful website. It's called Social Security Reformer. We'll post the address, but you can go there and you can just play around with some of these different proposals and see what it actually takes to make the system viable.
Okay. Well, not an easy or a simple topic, certainly, but you did a great job, I think, of giving people ways to think about it. So Justus Morgan, Financial Service Group, thanks a lot for being on Money Talks. Thanks to our producer, Scott Anderson. Please watch us again.